The Finance Committee meeting of the Carlington School District Board of Directors for February 9th, 2021 is called to order. Dr. Kreider, would you mind leading us in the pledge?
It would be my pleasure. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Will the secretary please call the roll?
Director Apple?
Here.
Director Hunchar?
Here.
Director Pushkar?
Here.
Director Mendoza?
I'm here.
Director Zaletsky? Director Simsik?
Here.
Director O'Brien?
Here.
Director Frank?
Here.
Director Shriver?
Here. I'll turn now to Dr. Kreider to kick off the Finance Committee portion for tonight.
Thank you, Director Shriver. For tonight's Finance Committee meeting, we have 3 reports that we are bringing to you. We are going to start with Mr. Jude Frank, who is going to give us an update on managing our general fund and fund balance through a risk analysis assessment, which we started last year, and he's going to provide us with an update. We'll then move to Steve Niedenberger, who is from our auditing firm, who will provide us with an update on our most recent audit. And then we'll shift over to Keith Bealby, and he will provide us with a finance update. So first, we'll start with Mr. Frank.
Okay, so I guess I can't see the slide. Can you let me know when the first slide is up?
Jude, do you want to provide some context?
Yeah, so while you're pulling that up, last year we had, kind of like Dr. Kreider said, last year we had several meetings where we talked about how to manage the fund balance and how to, and part of that, we had a lot of discussions about a 5-year plan or forecast, and how we could use those as tools to get ourselves into a position where we were kind of in a long-term, for the long-term financially sustainable. So what I'd like to do is kind of start talking through, with the presentation that I have is to review some of what we did last year, just to refresh everyone's mind, and then talk about how we'll be doing it this year and then going forward. I mean, the goal is long-term financial sustainability that allows us to keep offering the same opportunities we currently offer for a long time, and to give us control through difficult times and kind of ups and downs, maintain our overall control over it. So yeah, great. It looks like the first slide is up, so we can go to the second slide. I thought it would be helpful to just start out by reviewing kind of at a high level the key steps or the overall schedule for our annual budgeting process. So you can see in September, so this is already done, but PDE publishes the base index and then notifies all of the districts of an adjusted base index that's specific to them. And then in February, that's when the deadline for adopting the preliminary budget or a resolution to not raise taxes over an index. And I've got 2 little bullets down there because I think it's important to note that preliminary budget is really just a framework. So it's not a forecast. It's just a kind of a general framework for the budget. And then over the next few months, Keith and Dr. Kreider and then we'll work through kind of filling it out and through zero-based. Carlington uses pretty much entirely a zero-based budgeting methodology. And so they've already started that now, but kind of that preliminary budget is the framework, and then they'll, over the next few months, they'll fill it out. March is when, if we were to request a referendum exception or post a referendum, if we're going to seek a referendum on the, kind of a ballot, then that's when we would post it in March. May is when we adopt the final, like the proposed final budget. And then 30 days later, about 30 days later in June is when we adopt that final budget. And then in July is when it's submitted to PDE. So we go to the next slide. Going back to the financial situation. In the short term, our district, we're not financially unhealthy. But when we look out a few years, we do have challenges that we have, like everyone needs to be aware of, and that we're going to have to be able to navigate through. So, you know, under those future challenges, the first one, facilities investment, we have about $6 million of maintenance costs for our buildings that we have to do. There's always going to be maintenance needs, but we have several fairly high dollar issues that we have to address within the next several years. And really the top of the list is a high school roof. The second one, the jump step. So between 72 to 73% of our expenses are personnel costs. We have very little discretionary spending. Truly like short-term discretionary ability to control our budget. So over the next few years with that jump step, we're set to see probably, I think it's about a $2.5 million increase in personnel costs without any corresponding revenue increase. So if we're already running on an operating deficit, that's a pretty significant problem. Which brings us to the last bullet point, the operating deficit. So every budget for the last 9 years, we've forecasted annual expenses that exceed our forecasted revenue. And 6 out of those 9 years, we've actually realized it. And that's just not sustainable going forward for the long term.
Hey, Jude.
Yeah, go ahead.
Jude, could I add a quick comment? So
Yes, please.
the first part of your slide, I think, is really important for some of the newer board members that have not been around. Historically, let's say go back pre-2010, the district was running a small surplus every year. And what happened is, as the pension situation at the state level changed, our budget and every other district's budget in the state dramatically changed as well. So within a few short years, we went from running a surplus, or we were very close to budget being close to actual. We quickly went into a deficit position. And so in like the 12, 13, 14 range, the district realized that the model was fundamentally different than it had been a decade before. And for the first couple of years, the board acknowledged that they would temporarily use deficit spending to keep the programs intact, but that we recognized a longer term solution had to be found. And I think what you and David and some others did last year is fantastic, because you gave us a framework to help us look out 5 years to figure out what that viability looked like. So I think all of us are excited about the steps that you've taken and the work that you've done with the finance committee and the finance team. But historically, we've actually run surpluses. It was until that budget change with the pension crisis about 8 to 10 years ago that really changed everything. So that just a quick background for those newer members that haven't had that background.
Jim or Jude, for the public, could you be more specific? We all know with the PSERS crisis, the figures of it, but the public doesn't. Please be more specific.
Hey, this is Joe. So to give a little bit more history, the roots of this go back to like 1999, 2000, the PSERS crisis, which saw an increase in benefits and a decrease in contributions that were, the state makes the determination, and they were looking at some actuarial tables that I think were, the best way to say it, were pretty ambitious. And then they, if you remember, in the early 2000s, we went into a recession, and that previously fully funded pension then started going into a hole. And instead of reversing the cuts they made to the contributions and the benefits, the hole just kept getting bigger until I think it was, as Jim said, about 10 years ago, when it really started rocketing up in terms of what the local share of the pension fund or contributions are, which are now, and Keith, maybe you can help me with this. I think they're around 36%, but and we get some back from the state, but in any event, it's a significant amount of money, and it would also be unfair to not mention that the employees, teachers, and whoever else are involved in the PSERS fund, they've always made their contributions. So it's wholly a state induced crisis, and we all suffer because of it. But that's kind of the landscape that we're in, and it's a difficult it's a difficult situation. I mean, it's almost like trying to fight with one hand tied behind your back whenever it comes to keeping costs in line. So yeah, that I think that, George, does that kind of give you some?
Joe, thank you very much for expanding and giving us those figures, because the public really needs to know that 36% of each employee's salary is, in addition, 36% is given to PSERS, which is a huge amount of money for every school district in this state, but especially for a small school district like ours. It's tough.
It is, but George, I will say that we get 50% of that back. I mean, there's a time lag, but we only pay 50% of that.
Yes, I realize that,
Yeah.
but still, that 36% figure is awesome and hard to imagine. And tell us, we're not going to see a reduction, maybe a significant reduction for maybe 10 years or so, right?
Maybe 20, George.
Oh, geez. Wow.
Well, perfect. So thanks. So that's kind of leads us into the rest, like the next few slides, and kind of what I really wanted to talk about, and kind of the overall process that we kind of started last year, and it kind of mostly built around the fund balance. So if we go to the next slide. Yep. So the fund balance is a really important tool for us as a board. It's kind of it's something we can use to protect the financial health of the district. And so we just have to be extremely deliberate, understanding everything, kind of what we just talked about, understanding all of that. We have to be very deliberate, especially about those things that in the second set of bullets there I have under the long-term financial sustainability. We have to be very deliberate about kind of planning through that. So the first one is, I mean, I mentioned earlier that we have a $6 million of capital projects. So we really need to achieve kind of a stable cycle of facility maintenance costs. Ideally, you're always going to have some big dollar, some large dollar expenses, but to the extent we can kind of minimize those so that year after year, we've got some control over when we execute the projects. And then there's kind of a steady, $300,000 at a time annual expense. That's something that's really important for being able to kind of foresee expenditures and then also plan for kind of control your budget. And then the next two really deal with the fund balance, and that's kind of what I'll talk about. That's what I'm trying to address. So plan for foreseeable spending, and then also look at what you don't know and try to estimate how much you need to reserve for that, basically a savings account, right? Or an emergency fund. And then the last one there is we talked about this last year, but identifying all additional sources of funding. It sounds good to take out debt through a bond or something to to pay for something like the school roof, but we have to be pretty deliberate about how to do that. I mean, your fund balance as a percentage of your total budget is going to impact your interest rate that you get on it. And then also, the lower your debt load, the more flexible you are as a district. And I mean, that's we've got a pretty low debt load currently. And I think that's a strength that we have as a district. So if we go to the next slide, I kind of go into more detail about kind of how we're going to approach that fund balance. So when we estimate the minimum amount that we need to maintain in that fund balance, to basically handle kind of ups and downs or changes in the overall situation, kind of like what we saw this year with COVID, but also be able to maintain our own control over the educational experience that we're offering the students. We have to look at two different, and we did this last year, we kind of broke it out into two different categories. There's things that we know about. So reserving funds for what we know that we need to spend over the next 3 years. And then B, things that we don't know about. And the things that we know about that aren't in the budget are generally going to be capital expenditures. And then the unknown is going to be a combination of capital expenditures and then also a budget contingency category. And I've got a little bit more on that I think in the next slide. So if we go to the next slide, you can talk about that first category of the known. So these are basically unfunded capital projects, and they're not included in the budget. So, but we know that between now and then the next 3 years, we're going to have to do them. Last year, we used a 5-year window. This year, I've kind of narrowed it down to 3 years. Because ideally what we're talking about now would be an annual process, and 3 years to me seems like it's a more reasonable forecast window for John, Dennis, and the administration to forecast. And then let's see, if you can go to the next slides where we talk about the unknowns. So here, I mean, that first section, we had this in there last year too. We talked about this last year. Usually when school districts are going to formally set kind of a specific minimum fund balance, they'll use a percentage of expenditures, which is pretty simple and straightforward. And if you're going to finance major projects with a bond, it definitely makes sense. The process that we initiated last year, which is kind of what we're talking about now, is to look at our discrete needs and then estimated net risks, and then set a minimum fund balance based on that. And so what we've done is we've developed a model that we can use where we take the administration's estimates, and then we apply estimate ranges. So kind of they're expected and the kind of a low and a high against a triangular probability distribution, which will give us, when we use Monte Carlo, that'll give us kind of a median number to use as the basis for our minimum budget contingency. And that's kind of how we're going to do the risk analysis. And we're doing that that same process twice for the two separate categories here on the slide, the capital expenditure contingency, and then that budget contingency, which is essentially the operating budget. So the capital expenditures is going to be any projects that we expect, that Dr. Kreider or Dennis, and then also IT things that we know they expect we're going to have to do in the next several years, but maybe they fall outside that 3-year window. And then also when we look at things that do fall inside that 3-year window, maybe there's some contingency we need for that. So that's all going into that capital expenditure budget. And then we're doing that same process again, looking at the budget. So we take Keith's estimate of revenues and then expenditures, and then we do that same process and we come up with kind of a contingency number based on not just the one number, but looking at that overall probability distribution. So we go to the next slide. I'm showing what we had last year. So this table kind of shows the contingency estimates that we had last year. And last year when we did it, that was the first time we'd done it. And David and I we were working on it for a few months beforehand. So the process complemented the budget development, but it wasn't fully integrated into it. And so this year, what we're doing is we're fully integrating this analysis into the budget preparation. So we don't have the estimates yet because it's going to dovetail along with. Well, I've got a slide a couple down where it shows kind of how it fits into the schedule, but it follows with the budget preparation process. So one thing on the slide that I do want to talk about real quickly, underneath the table, you can see I've got a line that says the total estimated maintenance CapEx. And so if you look at 2020 to 2021, it says basically 6.2 million. And then this year, the number I have in there right now is about 6 million. It makes it look like we only executed about $100,000 worth of projects last year, which isn't accurate. I think Dennis and his team executed or is still executing on between $700,000 to $1 million on maintenance projects like the chillers and univents, which are pretty significant high dollar items. So, when we talk about that maintenance list, it's not something that's it's not one single list that we can dissipate over a period of time. There's going to be the few small projects that make a big dent when you solve them, but there's always going to be a lot of smaller projects. And every year you're going to have this constant churn of new. It's the same thing as you have with your house. You've got new projects. They're going to come in. And so kind of the idea is to tackle the large dollar projects. And then, which if we don't address them early, a lot of times what happens, the potential side effects of not addressing the high school roof is a perfect example where you kind of, there's compounding costs because if you don't fix one problem, then it ends up causing other problems. So the idea is for us to get that set of projects into something kind of like what I mentioned earlier, where we get them into a manageable cycle so that we have unless there's some large project that pops up, generally we know over a period of time that we can spend about $300,000, $200,000 a year on capital projects, and we can budget for it reliably and sustainably, and we can anticipate it. And we have control over when we execute the projects. And there's two, I think I already explained that. So I think we can go to the next slide. Real quick, I just want to talk about budget forecasting. So there's two components. One is what we've already talked about, the fund balance. The second thing is your long-term forecast. I've got it written there, but I think it's important to note that the long-term forecast is not a plan. A plan is something we're going to execute on, but it's still something that's really important and essential that we have. Because really those three bullets that I have under there. So one, setting up a couple long-term forecasts helps us kind of understand the gap between our current financial outlook and then where we need to be to achieve that long-term stability. And then when you do that, it's also going to highlight budget categories where you really need to focus on to close that gap. There's some things that you just, you can only make so much of a difference impacting your supply chain. Or transportation, some things you have control over, some things you don't have control over, some things you have direct control over, some things you have only indirect control over. And then the last bullet there, in the first section, the informed decisions. I think that's something that's really important over the course of the year where it kind of gives us, it's almost like an azimuth check. Anytime whether it's negotiating a contract or making some kind of decision, you can look at it. And if there's a financial impact, Dr. Kreider and his team are able to look at it and say, okay, does this help our situation or does it hurt? And you can just kind of roll it into one of those long-term forecast models and see the result. And it really helps inform decisions. And then, so for this year, last year, we only had two long-term forecast scenarios that we asked for. One was kind of current trend extended out 5 years, and then a balanced budget by 2025. And so I've added a third. So I think what we need to look at is, one, what's our current trend? And if we don't do anything, where are we in 5 years? The second one is, how do we fix that and achieve a balanced budget where our expenditures do not exceed, or that are equal to or less than our revenues for that year by 2025, but allowing us to raise, we're in that forecast, we're able to raise taxes every year. And then we can't raise taxes every year forever. And so we need to have another third look where we say, okay, how about if we can raise taxes next year and the year after that? So the first 2 years of the forecast, you can raise taxes, but don't raise taxes after that. What does that look like? And so that's the third scenario that I think we should look at this year as well, just to understand, define that long-term outlook. Which finally brings us to my last slide. And here, basically, it's the first slide that I had where we have the schedule, but I've layered in that risk analysis process and kind of the deliverables. So you can see we've already done the first one. So between September and February, we've got a preliminary model. We validated it more or less, and we've troubleshooted it some. So between March and May is when we'll finalize the risk analysis and set a minimum fund balance. And then that's also when Keith will develop those preliminary 5-year forecasts. And then after we adopt the proposed final budget, then we'll look to see, final 5-year forecasts, those 3 different case scenarios that we can use over the following year to evaluate key decisions. And with that, that's all I had. So I guess open up questions or discussion or.
Questions from any board members?
I don't have any questions. I'm just really, really appreciative of the work that, was put into just giving us this framework and, the ability to try to forecast and have reference points. So just thank you so much, Jude, for, doing the work on this, and as well, the administration and everybody who helped to develop this plan. I appreciate it.
I'll second that. Yeah, I agree, Chris.
Yeah, definitely. Very thorough presentation, and it's got me thinking a lot about, especially that the second to last slide, talking about the 5-year forecast scenarios and, getting a balanced budget by 2025, which is really only 4 years now. So, yeah, with the craziness of the last 10, 11 months, I wonder how much of the work that you and David Russos did last year, as far as a forecast, changed. I mean, there's a lot more, it seems to me, unknowns now than there were previously, whenever we were kind of living in a world that we were used to. Do you have any thoughts on that, Jude?
I do, Joe. I agree with you. I think what we'll see. I mean, I think that's the idea of doing this every year, where it's not, we don't set one number and then hold that number for 5 years. We just redo the process as part of our budgeting. And I think what we'll see is maybe we'll have a higher, last year we had a pretty low overall contingency that we needed to maintain.
Mm-hmm.
And so we'll probably see that go up some. I don't know how much, but I think that'll be the result. Is what'll happen is as the uncertainty goes up, we'll just need to get closer to that 8% number in the fund balance or something. And that's, I mean, the idea here is this is not how much we should maintain in the fund balance. This is the minimum we need to maintain in the fund balance, right? So.
Right.
So any plan, any plan the administration gives the board, they can't go below that number. That's the minimum. That's the idea here.
Gotcha. Thank you.
Anyone else? If not, we'll turn back to Dr. Kreider and you can continue the rest of the finance meeting.
Very good. And thank you again, Mr. Frank, for that presentation. As every social studies teacher will let you know, it's extremely important that you look towards the future. It's also important to look towards the past. And our next presenter here, Steve Needleberger, will take a look at the past and he has gone through and prepared some information in regard to the audit from the 2019-2020 school year.
Good evening, everyone. I'm here, like your superintendent mentioned, to talk about the 2019-2020 school year. So this would be information relating to the year end June 30th, 2020. If you have your audit reports with you, I'll reference a few page numbers throughout the presentation if you want to follow along with that. And as I go along, if you have any questions, or at the end, if there's any questions or anything, I could try to answer them best I can. The first thing I want to point out is the first 3 pages of this audit report, pages 1 through 3, it's our independent auditor's opinion. And that's what we contribute to your audit report. I'm pleased to say that it was an unqualified opinion, and that's the highest level of opinion we could provide on the financial statements. It's also known as a clean audit opinion on the Carlington School District financial statements for June 30th, 2020. I'm going to take a few minutes to look at a few of the key indicators in your exhibits. If you have your report with you, page 17. Page 17 is the balance sheet of the school district for the governmental funds. You have 2 governmental funds, the general fund, which is your main operating fund, and then also your capital projects fund. You see the general fund at year end had total assets of $11.5 million, while you had total liabilities of $5.5 million and deferred inflows of $2.7 million. This resulted in a total fund balance of $3.3 million in the general fund, of which $622,500 was assigned for the future increases in the PSERS rates and also healthcare cost, along with future technology needs. Also on Exhibit 3, the balance sheet here for the Capital Projects Fund, you can see there was a total of $1.4 million in assets, while there was an assigned balance of $1.4 million for future capital needs of the district. Flipping a few pages forward to page 19, this is Exhibit 5. These are the same 2 funds we just spoke of, the governmental funds, the results of the operations for the year 1920. You could see the general fund had total revenues of $29.5 million with total expenditures of $27.9. And with this amount of revenues exceeding the expenditures, you were able to transfer $1.4 million to your capital projects fund during the year. So the net change in your fund balance in the general fund was a positive $208,000. You started the year at $3,094,000 fund balance and ended the year at the $3,303,000, like we spoke of on Exhibit 3. Your capital projects fund had $766 of interest earnings. You had a little over $75,000 of capital expenditures in the 1920 school year. And you see you had to transfer in of the $1.4 million from the general fund. So your fund balance began the year at about $74,000 in the capital projects and ended the year a little over $1.4 million. There's 2 other fund types at the school district. I'm going to draw your attention to page 22. This is a proprietary fund type. It's your food service fund. And you can see the very bottom line has a total net position of a negative $231,000. I just want to point out that the proprietary fund has to have all the long-term liabilities on the face of the statement. Your OPEB and net pension long-term liabilities, which you fund throughout the contributions during the year, totaled about $607,000. So if it wasn't for those liabilities being on the balance sheet, you would actually have a surplus, a positive net position in your food service fund. But under Governmental Accounting Standards Board's principles, the food service fund has to be shown in this manner. Let me just flip forward 1 page to 23 to show you the actual results of the operations of the food service fund. If you actually take a look at page 23, you could see that there was a 3 lines from the bottom, a decrease in the net position of about $128,000 during the school year. Now, which I'll speak of shortly, COVID-19 obviously had a major impact on these financial statements. Obviously, you weren't getting the student meal revenues from middle of March through the end of the school year. There was some subsidies still from the federal government. However, that greatly reduced your revenues in the 1920 year, which resulted in this larger than usual decrease in the food service fund's net position. The final fund type is actually on page 26, Exhibit 10. This is a fiduciary fund. It's actually your student activities funds. And at year end, there was $88,000, a little over $88,000 in the student activities monies. I just want to draw your attention to the debt footnote, the long-term debt footnote, which is actually on page 38 in this report. It's note 8. You could see at June 30th, 2020, you had $4,485,000 outstanding on your general obligation bond. And along with the capital lease payable remaining on your capital lease of $77,000. The next area I wanted to really focus on was the required supplementary information. And this begins actually on page 54. What this basically is a budget to actual analysis for your general fund. On page 55, you'll see about a third of the way down the total revenues for the general fund for the 1920 school year. The second column is the budgeted amount of $28.8 million. The third column over is the actual. You actually had $29.5 million of general fund revenues, which exceeded the budget by $634,000. Part of this was due to some additional federal funding during the school year due to COVID-19. The next item on this analysis for the general fund is we could actually flip to page 60, the last page of this analysis. I wanted to point out that your total expenditures and other uses of the general fund monies actually exceeded the budget. 4 lines from the bottom, you could see that you had a total budget expenditures and other financing uses of $29.5 million, while you actually only spent $29.3 million, and that includes the $1.4 million transfer you made to the capital projects. This was a positive outcome of $284,000. Your expenditures were less than your budget amount for the 1920 school year. That shows a strong fiscal management, and also there were some costs that were saved in the 1920 school year. It was an unusual year due to COVID-19, such as transportation. You already were going to be under budget in the 1920 school year for transportation, but then with not transporting the kids, you weren't obligated to pay the full amount to your bus company, which also saved you some money. So in essence, there was budgeted to use fund balance in the 1920 school year of $710,000, but you actually added to the fund balance $208,000. So you had a positive for the year, budget versus actual, in the general fund of over $900,000. And once again, keep in mind that this was a little unusual due to great savings in the transportation cost and also some increased federal grant monies due to COVID-19. At the very back of this audit report is attached the single audit report. Anytime $750,000 of federal expenditures is expended in a school year, you're required to have a single audit. So, of course, we did that in accompaniment to our regular audit. Carlington actually had about $1.6 million of federal expenditures, so you well exceeded the amount that triggers a single audit. We tested your Title I program as the major program, and I'm pleased to say that we were able to issue a clean opinion on the federal programs for Carlington School District also. There was no findings or question cost. So just in summary, from the 1920 school district audit, we were able to issue a clean opinion on these statements, and your results were a little bit better than budgeted, partly due to the unusual year that COVID-19 presented us all. I know that's a lot of information in a short format, but did anyone have any questions?
Maybe we can have Keith help us digest this in the coming weeks. So Keith, you can digest it being new, and then you can help us as a board digest the key highlights from this. And this, accompanied with Jude's efforts, I think will be a great budget planning tool. Overall, though, your opinion was favorable.
Yes, it was a from an audit standpoint, what we look at is we really look at your internal controls to make sure they're in place to allow you to capture and accurately report your data. And obviously, that's what goes behind our clean opinion. I mean, everything was in place and things were very positive. And that's, obviously, your numbers. That's what you guys put together. We go through a lot of procedures with that, but really our role is to make sure that your accounting function, mainly your business office and some supporting staff, are operating in a manner that need to be to properly have your financial statements prepared each year for all the different filings that are necessary and to get your clean audit opinion.
Thank you.
And if anyone does have any questions, if they could just refer them to Keith and he'll get in contact with me and I'll be glad to help answer or help the transition that's occurred the last month or two in the business office.
I do have a quick question to pull a through line from Director Frank's presentation. It looks like that from 2015 until 2020, we've gone from about a 20% contribution to PSERS as a percentage of covered payroll to 33%. Is that accurate? Am I reading that correctly?
Yes.
Okay.
Actually, the 1920 school year, your contribution rate was 34.29%. And there has been a continual growth in that rate, just like I believe the treasurer spoke earlier. It's sort of leveling off right now. It's only changing by a couple of percent the last few years. But most of the damage was done between, 2010 to 2015. It's starting to slow down the last 2 or 3 years. But yes, and there's a lot of information in the report about the net pension liability. I think the key thing to keep in mind is the school district contributes, and that's your expense, which we spoke of, the 34% for 1920. And then that net pension liability is just for future actuarial purposes. What of PSERS relates to the Carlington employees. So, there still will be some small increases, but you're pretty much at the max almost right now.
Thank you.
Susie,
But
just
to be clear, the state does refund us for 50% of that, correct? I know we pay the upfront cost, but we do get refunded. So over a period of time, it's really, the expense to us is really just 50% of that.
Correct. Yeah, through state subsidies, you're receiving approximately 50% of that, which is standard for all the school districts in Pennsylvania. So yeah, if you were really to look at your net cost of the retirement for PSERS, yeah, it's more like your 17%.
Jude, to add context to that, though, in around 2010, our contribution rate was just under 5%. So
Right.
over the period, as he said, from 2010 to 2015, it went from roughly 5 to 8 to 11 to 14 to 18 to 22 to 25. And we're now in the mid 30s and projected to be there for about 20 or 25 years. So agreed that we get half of that money back, but our gross contribution around 2010 was about $400,000, and it went to 700, it went to 800, it went to 1.2. At one point it hit about 3.5 million per year gross. And yes, we got half of that back, but from a impact on our ability to budget, that just destroyed us and every other school district, or most other school districts. It's catastrophic. So hence the need for your planning tool to help us look at that component as well as all of our other expenses and make sure that we're planning out several years to make sure we can pay our bills and keep the programs intact.
Yeah, to jump
Agreed
on to
completely. And it's something we don't have any control over, which is important, other than staffing levels.
Agreed.
Well, yeah, and to jump on what Jim said, just looking at the numbers that are on this, and before Susie brought this up, and I'm glad she did, I was looking at this page as well, and while it's true that the state refunds us half of what we pay, we're still talking about around $1 million over 5 years, like increase. So, and that's really not that we've been spending more money, like a lot more money. It's just that the cost has gone up. So, we don't really get a benefit by spending more money. We're just maintaining our expense level, and as people get raises and that sort of thing, it's not like we've gone on a hiring spree and now we've got a significantly higher payroll. No, it's that extra, right now it's like $1 million more a year than it was in 2015, but that's going forward too. So that's not an insignificant amount of money, and by any means.
Yeah, actually, in the audit report, page 63, it has from 2015 to 2020 your contractually required contribution, and you could see in 2015 it was 2.2 million, while in 2020 that was 4.0 million. And now remember, that's the full gross amount on this schedule, but that really points out what you guys were just discussing.
Yeah.
Keith, with all of these very good questions and the dialogue, and you being a fresh set of eyes, but with a lot of good experience in this ecosystem, maybe sometime in the next month or two, as the budget cycle continues, maybe you can help us look at these numbers as a board and understand them in a more intimate way, and give us some context from some of your other experiences, and that might help us digest this a bit.
Yeah, I think that is really it's a good exercise to be able to do that, because I mean, it's something that we don't control. It's something that we have to accept, and I mean, every time it keeps continuing to go up, salaries are going up, and it doesn't balance out with the ability to generate that revenue. So the expenditures are always going to be out, expending the revenues that you can bring in for it. So you're really limited on how you can control it, and unfortunately staffing is one of the ways to do it, but I can do that. Yeah, absolutely. It's a big issue that we've all been dealing with for over the last 10 years, 11 years. And, unfortunately, like everyone has said, it's supposed to peak out in about 3-4 years at 38%. And then it's going to hold for about 20 years. And, by peaking out, I mean, it's still going to be that consistent amount that we're going to be having to pay, and it's going to increase. Like I said, every time that we have increase in our salaries, contractually or by adding more staff or deleting, that's the only way you're going to adjust it. So, absolutely, I can put it into context for you all.
Very good. Thank you, Mr. Niedenberger. Appreciate it, both to you and to your firm as well, for the amount of time that you dedicated towards putting this report together. I know that both the board, the administration, and our community appreciate all your work and the insight that you provide. As we look back historically, it helps us plan for the future, which does segue into Mr. Bealby, who will talk next about the current. Mr. Bealby.
Okay, thank you.
All right. Can you make it a little bit bigger, Josh? First off, I want to say good evening to everybody, and I just want to say, how much of a thrill it is for me to finally be here. I'm glad I was able to get here a lot quicker than what everyone expected. It's a welcome relief for both me and hopefully for you too, that I can jump in. There are a lot of challenges ahead of us, but I like to look at it as they're good challenges, because right now financially we're in a good shape. But as been alluded in the last with Director Frank said, and everyone, if we don't start looking at this now and we don't start watching it monthly, it could go down quickly. And before you know it, we're going to be in the hole. And that's not the time to try to react. I've been in that situation where, you're trying to dig out of a hole, and it really is almost an impossible task to do without making drastic changes to the district, and actually to with staffing, cutting supplies, and extra programs. So the whole point is that, as I said in my interview earlier, our whole point is that we need to maximize the revenues that we do get and funnel as much as we can into programs for the kids. We want to give the teachers the tools they want. We want to do everything for the kids. So that's why I think that it's really important that we are focused on this, that we are looking at, a 5-year forecast. We are looking at the risk analysis. Very important tools that can keep us to the point where we're not digging out of a hole. So in the last couple of weeks, what I've been able to do is take a look at the numbers. And I came up with this spreadsheet. I'm sure this spreadsheet kind of looks a little bit like what Chris used to do, Mr. Jeswick. But this spreadsheet, it's actually a really good tool when you first get into a district or anytime you're looking at it, because what it does for us is it allows us to look at 1920 or the previous year and the current year and see, are they kind of trending the same? Granted, every year is not the same, but it at least allows you to look at each of the years and say, hey, yeah, we're staying pretty much on track, because really year to year expenditures don't change that much. So that's why this is a good tool. And then, the second and the third column on this spreadsheet, you also have to look at where are you this year? So, this allows you to say, okay, here we are with our, salaries. What are we compared to our budget? And just kind of see, are there any outliers out there? So what that would tell me is, is there something I need to look at? Is there something that we budgeted incorrectly? Or is there something that we did that we have to look at in the future? So this is basically what we had. So what I did is I took it back to January 31st. And if you look at our trends, pretty much we're pretty on track. I mean, if you look at the expenditures, if you look at 1920, we're at $13.6 million last year at this time. This year we're at 13.4. So we're really close. We're really, staying pretty steady with that. Compared to the budget, we're at 44% of the budget. What you would want to expect to see is you would want to be probably right about even with it. We're just a little bit over a half a year. So you want to see it under, 60% or under, or 50% and under. So 44% is showing us that, we're doing okay. It's going to be hard this year, as Steve said previously. With this COVID, with all the different changes, the kids in and out, and the different money that's coming to us with the different CARES Acts and everything, it really is hard to estimate where are we going to be. I mean, it's going to be a challenge, and it's going to be something that is challenging all of the business managers that, to give us the tool give you the tool to say, where are we going to be? Because that's always a big question. Where are we going to be at the end of the year? How am I going to be able to justify if I have to raise taxes or if I don't know where we're going to be? So that right there is the biggest challenge that is facing us. So if you look right now, 42% of our salaries have been spent, 46 of our benefits, 35 of professional purchase services, purchase properties, 54%. And as you keep on going down, everything is staying pretty consistent. So we're looking really pretty steady right now. There's nothing on there that is a big concern for me that I have to immediately start looking at and try to fix. If you want to move down a little bit, Josh. So when you go down to the revenues, same thing. You want to look at kind of where you were last year and where you are this year. So if you see with the taxes, last year we were at 16.3 million. This year we're at 17 million, which makes sense because we did raise taxes last year. And the biggest thing is that if you look at that 17.739, the budget was 18.157. So this taxes is not only real estate tax, but this is your earned income tax, your transfer tax. So it's a combination of all the taxes. So right now, halfway through the year, we've already collected 98% of our taxes. Granted, a lot of it is the real estate, because real estate was collected all the way until the end of December. So we're pretty much done with our collection for the year for that. But that's a good sign. And a little bit later, I'll break it down a little bit, the taxes that were concerns to all districts whenever we were doing the budget at this time. So when I look at this, the delinquent taxes, that right now is only at 20% of our collections. But right now, that's where we were pretty much last year. So we're trending the right way. It's delinquent taxes is another one of those hard ones that you have to really guesstimate. You know, usually you can go through several years and say, okay, this is the average. But once again, with the COVID and people not, you know, being unemployed, but it's harder for people to pay taxes. So you're going to see some dip. And I believe that some of these budgets, and talking to Chris, have been adjusted to accommodate for some loss of income from those. And as far as earnings from investments, that's really down. And that's one thing that I will be looking into to see, you know, are we maximizing how much money? I mean, right now we did switch banks. We are getting a better rate than we are with our PSLAF investment bank. So in the next couple of days, I'm going to take a look at that and try to move as much money as I can into that higher interest bearing, just so that maybe we can recover some more of that. Because I mean, we're only down 18,000, but if I can get to that and maximize it, you know, with the opportunity from this introductory rate that we have from the bank, then, you know, there's no reason that's easy money for us to do. So that's one of the concerns that I can see that I have to work on. And the revenues from local sources, that's down. It's 11%. A lot of that is, you know, with the kids being out, we don't have the admissions to, you know, the ball games. We don't have different clubs, not clubs, but different things that are happening in the school that we collect money. So that too is expected to be down. But I need to do more research on that also. So that just, like I said, this is a great tool to say, where do I have to look? You know, what are we doing wrong? How can we maximize it? Does it need to be adjusted? So that's those two are concerns right there. State subsidies are staying right online. The state grants, as you see, it's at 104% of the budget. And basically that's because we've been able to receive some extra grants through the CARES grant, the ESSERS grants. There's a couple safety grants that we've gone and applied for. So that's one that you always want to try to see that you can maximize, or even, you know, go above what you have budgeted, because there's opportunities out there. You just have to take the time to go out and find those grants. And retirement subsidies, and honestly, that retirement subsidies, that should be, well, that's at 8%. That's about right, because they pay us quarterly, so we would expect that it's going to be a little bit low as it goes. And you know, as I do a presentation like this, you're going to see the number. All these numbers will climb up. And then on the federal grants, that those are going to be coming. A lot of those with the ESSER grants, the CARE grants. A lot of them, they give us a little bit of money at a time. Just kind of, I want to say they're little teasers for us. But for us to be able to actually get all of the money, we have to submit to them, you know, once we complete it. So the more that we submit, the more money that we get up to straight. So that's why that's down a little bit. And then the medical access reimbursements, right now it's at 1%. That would be notoriously a little bit low at this time of the period, because for the access, what happens is that as we go through the year, we apply through medical access some of our, you know, the paras that work with the access children, the teachers, the different organizations. So what that does is, as we do it quarterly, then the state funds our account with money that we can draw down. So that's strictly a drawdown account. So we need to go through and physically say, okay, here are the invoices, here are the salary schedules, submit it to the state, and then they'll send us the money. So that's something that I will have done between myself and with Sarah from, you know, within special ed. We're going to work together. We've already had a really good meeting the other day, and we bounced off ideas to how we can increase that. And that's another one of those revenues that the more effort you put into it and identifying more of the objects, then you're going to be able to pull in some more money. So hopefully we're going to see in the next year or so, we're going to increase how much revenue we're going to bring in there. So anything that we can do that lessens the need to go to the local, revenue, or, to our taxpayers to say, we're going to do our part to find money outside of having to just keep going into your pocketbooks and wallets and say, give us more, because that's not the goal for any of us, and we're not going to plan on doing that. Go ahead, Josh, you want to go down a little bit? So two of the areas that everyone was concerned about was real estate collections and earned income tax collections when it comes to the COVID, and the concern was the ability for people to pay, for the same reasons that I stated before of, unemployment or just, the everyday struggles. You're going to fund, your actual, lifestyle living, to survive than to pay taxes. So if you look at our real estate tax, we exceeded what we budgeted. So that shows that everyone paid their taxes, and they did a great job with paying their taxes. It might be a little inflated because we did lower it a little bit. I think Chris did lower the amount of our collection rate a little bit. But then by us seeing that this is at 84 or 104%, then I know next year I can raise that a little bit, our collection rate a little bit, so that we can, right size it and make sure it looks good.
Just on that point, sorry to interrupt. I think some of the concern was we didn't know at a macro level what the impact of the COVID would be on money, the individual family. So
you're absolutely
we
right.
still may see an impact. I think right now we're grateful that the impact hasn't been very great, but there may be a change.
No, you're absolutely right, and that's very true. The economy has rebounded a little bit, over the year, but you never know what's going to happen. I mean, it could keep swinging back and forth. So, no, you're right. That's every budget that was done. We had to take that into account. That COVID was affecting the ability for everyone to pay. So the real estate and the earned income, and the earned income, if you look at it, it only shows that 38% has been collected year to date. But if you look at the previous year where we had almost the same, or actually we didn't have the same situation, because last year at this time, we were just going into the COVID. So we're actually right on track. So to me, looking at this, yeah, there's maybe a little bit of impact, but also I just, want to caution you to say is that we did lower our expectations on the budget. So, no way am I saying that this is going to be the same as what it was last year. It's just, this is based on our adjusted numbers that we have done, based on our assumptions of where we thought. So those are important to look at and to understand that, revenues are coming in, but we also adjusted it, and we're going to have to constantly look at those collection rates from year to year and see, how we're going to be able to adjust that. So that's on the basic level. And that's going by, the functions of 100s and stuff. But Josh, if you want to pull up the other spreadsheet, I'll go through that really quick. This one takes it a little bit deeper, where we look at actually looking at the functions, so we're looking at the regular programs. So the regular ed, the salaries, employee benefits. So it breaks it down more under each function, and it takes it down to the 100, 200s on each level. So then we can once again look at the outliers. So it still comes out when you go down to the very bottom, it's a 44% of budget spend, but this just gives me a little bit more detail, and also allows you, if you want to look at it, to say, how are we doing on special ed? What are we spending on them compared to the budget, or just in general, just to see. And we also will look at, like, in the 1100, 400s, we spent 94% of our budget. That to me would say, okay, let's take a look at it. Let's see, was there things in there that was not budgeted that we have paid for, and do we need to account for that next year? Or is it something that was miscoded possibly? So this is just another one of the tools that I use to be able to go through the budget. So Josh, if you want to just keep moving down, and it just goes through every single different functions, vocational ed, the other instructional. So looking through this, right now, there are a couple accounts that are getting close to that 90% that I will look at. And I don't know how, and I'll have to look to see what has happened in the past. If, they did budget transfers for the years, to come to like every year or month and say, we're going to keep the budget accurate by doing transfers, or we do it all at the end. But that's something that, I'll have to work on. Like I said, there's a lot of work. I'm in the infancy stage of, learning Carlington Way. And, but right now, just from my initial analysis of everything, I think that the budget looks it's in good shape. I think that the procedures that are happening right now are working. Some can be tweaked, but my role right now is to just observe. It's not for me to come in right now and say, your way is the wrong way, we're just change it. So I'm going to observe, I'm going to notice things, I'm going to see things, I'm going to bring them up to Dr. Kreider. If it comes to the point where I need to come to the board, I will come to the board. So I'll be very transparent about what I'm going to do, and then, we'll see what happens. So that's basically, where I want it to be, right at this point. It's just, like I said, I want to learn the Carlington Way. So that's what I have. If I have any questions, I'll feel free to ask, at any time. If you want to send me an email if you have a question, I'll answer it any time. Okay.
Anyone have questions for Keith? Hey, Dr. Kreider. Thanks, Keith.
Thank
Appreciate
you.
it.
Very good. Thank you, Keith. And Mr. Shriver, as far as the administrative reports, that's all we have for the Finance Committee meeting.
Okay. Any board member have any finance questions or any other general questions before we adjourn? Do you have anything else?
No.
You're good?
I'm good.
I'll entertain a motion to adjourn if we need such.
I
So
so
moved.
moved.
I second.
Moved and seconded. All those in favor say aye.
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 Aye.